Hello, friends and fellow econ aficionados. Welcome back to another edition of Boss Economics World, where we peel back the layers on today's economic circus, no holds barred, and with a generous dollop of biting wit. Today's spotlight shines on one of the financial world's most glittering protagonists, gold. Yes, that ancient metal, historically revered as a safe haven, is now being touted by Goldman Sachs as the canary in the economic coal mine. But, as always, when you dig deeper into these projections, the numbers tell a tale of turbulent markets, government missteps, and policy uncertainty that could rival a Shakespearean tragedy. So grab your popcorn, let's dive into why our economic overlords are suddenly so enamored with gold and what that spells for our future. Goldman Sachs recently upped its year-end gold target to a staggering $3,100 an ounce. For those who've been living under a rock, or safely diversified their portfolios, this isn't just idle chatter on Wall Street. According to analysts Lena Thomas and Don Streven, this ambitious target is driven by robust central bank buying and a surge in inflows into bullion-backed exchange-traded funds, ETFs. But why now? What has transformed the status quo to suddenly favor the humble metal? At its heart, the recent rally in gold prices is symptomatic of broader economic disillusionment and widespread distrust in current fiscal and monetary policy directions. Central bank demand is now estimated to average 50 tons per month, a figure that belies earlier predictions. Meanwhile, some forecasts even hint at potential pushes up to $3,300 an ounce. That's a jaw-dropping 26% annual gain according to Bloomberg calculations. Such a speculative burst is not born of haphazard market optimism, but rather a response to a confluence of disturbing signals, relentless policy uncertainty, the unsettling specter of inflation, and the erratic behavior of policymakers. Let's get serious for a moment. Central banks worldwide, particularly those clinging to large U.S. Treasury reserves, are flocking to gold as a defensive asset against fiscal risks. In December alone, official sector purchases reached an estimated 108 tons, with China stepping up and claiming 45 tons of that bounty. In a world where governments seem increasingly preoccupied with short-term political grandstanding, think tariff wars and erratic interest rate decisions, gold offers a timeless store of value immune to the whims of political fads. The logical deduction here is clear. When confidence in government fiscal management wanes, central banks turn to gold as their security blanket. And this isn't a mere academic hypothesis, it's a trend backed by solid data. Historically, shifts in central bank holdings have always been harbingers of broader economic disquiet. In fact, earlier this year, when the Fed embarked on a series of rate cuts in an attempt to stimulate a sagging economy, it inadvertently fanned the flames of investor anxiety. Rather than bolstering confidence, these cuts signaled that the systemic issues were deeper than the surface-level economic indicators might suggest. Now, let's not mince words, it's high time we confronted the elephant in the room. The erratic economic policies championed by our political elites, most notably in the United States, are eroding global market stability. President Donald Trump's series of unpredictable and disruptive tariff announcements, for instance, have sent shockwaves through global trade networks. Tariffs, often hailed as tools to protect domestic industries, have too frequently morphed into instruments of political brinkmanship. The resultant trade tensions not only stoke fears among investors but also contribute to the narrative that the economic game is being played by amateurs with a short-sighted agenda. When policymakers choose to engage in tariff battles rather than focus on sustainable economic management, they create an atmosphere of chronic uncertainty. Investors, from the seasoned portfolio managers on Wall Street to the average Joe reading their retirement app on his phone, are left with a single, unsettling conclusion: the current administration's inability to craft coherent, forward-looking economic policies is driving a tilt toward safe haven assets. And what shines brighter than gold in times of crisis? Another key piece of the puzzle is the persistent fear of runaway inflation structure. While central banks worldwide are ostensibly trying to stave off deflationary pressures, their efforts often result in a delicate balancing act that sometimes tips over into fiscal imprudence. Recent data shows that inflation fears, particularly in economies with significant debt burdens, have resurfaced. In the United States, for example, inflation has been inching upwards, fueled in part by expansive fiscal policies and a hesitant approach to tapering quantitative easing programs. Government spending, which was once rationalized as a necessary evil in times of crisis, has evolved into routine policy. Yet, it remains largely disconnected from productivity gains and robust long-term planning. As central banks begin to worry about the sustainability of their U.S. Treasury reserves in the face of ever-mounting fiscal deficits, they pivot to gold, the one asset that gleams with promise even when confidence in paper money falters. Adding another layer to this economic drama is the surge in inflows into bullion-backed ETFs. These funds have emerged as a popular vehicle for investors seeking to hedge against market uncertainty. With the potential for a gradual boost to ETF holdings on the horizon, especially if the Fed opts for further rate cuts, the decision to pile into gold isn't surprising, it's almost inevitable. This trend isn't just a speculative gamble. It's a calculated move by both retail and institutional investors who have grown increasingly wary of the consequences of unbridled monetary expansion and lackluster macroeconomic governance. Recent numbers underscore how the market has shifted its focus. In the past 7 weeks alone, gold has set successive records, an achievement that can only be attributed to a market that's convinced even the most skeptical analysts of its value-preserving properties. When a metal that has been used as currency and a store of value for millennia starts to dominate headlines like this, it's a sign that the underlying economic currents are anything but tranquil. This isn't an isolated phenomenon. Look around, governments across the globe are wrestling with the fallout of policies that prioritize short-term political gain over long-term economic soundness. Whether it's the ill-timed tariffs that have rattled the international marketplace or the delayed responses to speculative bubbles in housing and technology markets, mismanagement is, unfortunately, becoming the norm rather than the exception. Take, for instance, the staggering fiscal deficits in several developed economies over recent years. Despite repeatedly being warned about accruing debt levels, political leaders continue to craft policies that exacerbate the problem. In the United States alone, the national debt has been on an unsustainable upward trajectory, reaching levels that experts warn could soon impede the country's ability to finance crucial public services and investments in infrastructure. From this perspective, the pivot to gold is less an investment opportunity and more an unmistakable flight from economic reality, a symbolic move that reflects deep-seated distrust in the current government's ability to steer the nation through turbulent economic waters. Let's bolster our argument with some fresh, hard-hitting data. Recent studies indicate that central bank gold reserves have been accumulating at rates not seen since the pre-crisis era. For example, the International Monetary Fund's (IMF) latest reports revealed that global gold buying by central banks reached record highs in both 2019 and 2020, underscoring a shift in asset allocation strategies. Moreover, a survey conducted by the World Gold Council found that over 60% of institutional investors now view gold as an indispensable part of their portfolio diversification strategy, a marked increase from just 45% in the early 2010s. Furthermore, empirical evidence from countries like Turkey and Argentina, nations that have long struggled with inflation and currency devaluation, demonstrates that gold ownership can serve as an effective countermeasure against economic instability. In these economies, where government policies have frequently been mismanaged or undermined by corruption and short-sighted agendas, gold has often been the only asset that truly retains its value over time. These case studies are a clarion call to other economies grappling with similar challenges, signaling that reliance on traditional fiscal prescriptions may no longer suffice in an increasingly volatile global environment. Of course, the narrative of gold's ascent isn't confined merely to the metal markets. Its repercussions ripple across the global financial system. Higher gold prices tend to signal a loss of confidence in fiat currencies and an increased risk aversion among investors. This, in turn, triggers a broader reassessment of asset allocations, diversification strategies shift, and capital tends to flow out of stocks and bonds into commodities. The banking sector, which already faces headwinds from tightening monetary policies and rising default risks, may find itself contending with additional pressures as market participants seek refuge in safer, though less liquid, assets. Moreover, the interplay between rising gold prices and the US dollar is particularly telling. Historically, these two have maintained an inverse relationship. As confidence in the dollar declines, gold becomes increasingly attractive. Recent data mirrors this pattern in stark detail. With the Federal Reserve's policy moves creating more uncertainty than clarity, it's not just Wall Street that's rethinking its long-held positions, central banks are, too, recalibrating their reserve compositions. This isn't a coincidence, it's a response to sustained fiscal imprudence and an uncertain political landscape that leaves little room for calculated risk-taking. So, where do we go from here? The answer is as clear as it is disconcerting: the current trajectory is unsustainable. The persistent policy uncertainty, from disruptive tariff wars to ill-conceived fiscal measures, must be addressed head-on. It's high time for policymakers to recognize that managing an economy isn't about chasing short-term gains or scoring political points, it's about crafting a coherent, forward-looking strategy that instills confidence in all market participants. Practically speaking, this means multi-pronged reforms. Governments need to tighten fiscal discipline, curtail excessive spending, and foster an environment conducive to sustainable growth. Monetary authorities must strive for transparency in their decision-making processes, avoiding knee-jerk reactions that only serve to further destabilize markets. Crucially, there must be a paradigm shift from reactive to proactive policy measures. Instead of scrambling to patch up economic gaping holes with ad hoc interventions, a long-term structural approach is vital, one that prioritizes investments in infrastructure, education, and technology. These sectors not only promise sustainable growth but also help diversify the economic base, reducing the over-reliance on any single commodity or currency. In closing, the soaring gold price projections are symptomatic of a broader malaise permeating global economies, a malaise rooted in mismanagement, short-sighted policies, and deep-seated uncertainty. Goldman Sachs' bullish forecast isn't just a market insight, it's a wake-up call. As central banks increasingly turn to gold as a hedge against fiscal imprudence and policy vacillation, the writing is on the wall. Our current economic management strategies are failing both ordinary citizens and seasoned investors alike. Whether you're an everyday investor clutching your retirement savings or a financial professional analyzing global trends, the message couldn't be clearer. The golden glow that once symbolized timeless value is now a stark reminder of how far we've strayed in our quest for economic stability. It shines as a beacon of caution against further policy missteps that continue to plague governments, urging us all to demand accountability and a return to sustainable, rational economic management. So, as you watch central banks steadily pile into gold and ETF inflows surge with each unexpected Fed cut, ask yourself, when will our policymakers stop chasing quick wins and start thinking about the long-term health of our economies? Until then, the gold market will continue to be the ultimate barometer of our collective economic uncertainty, a glittering symbol of hope for some and a painful reminder of mismanagement for others. This is Boss Economics World signing off, keeping it real, keeping it golden, and always questioning the status quo. Stay tuned for more deep dives into the trends and crises shaping our financial future.